policymakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, President Trump says his administration will start sending out letters setting unilateral tariffs rates later today. Now, it comes just 5 days before Washington's July 9th deadline for negotiations, with many trading partners still struggling to finalize deals.
We're going to start sending letters out to various countries starting tomorrow. We'll probably have 10 or 12 go out tomorrow. And over the next few days, I think by the 9th, they'll be fully covered. And they'll range in value from maybe 60 or 70% tariffs to 10 and 20% tariffs.
Plenty to discuss with Nataliia Lipikhina, head of EMEA equity strategy at JP Morgan Private Bank, Ross Matheson, Bloomberg's EMEA news director. But first, let's bring in Brendan Murray, who leads our trade coverage. First of all, Brendan, it's the 4th of July. I thought Americans stopped working on the 4th of July. So the fact that we're getting details today about the president, saying what he wants to do today, I mean, is it boisterous or what's the strategy?
Yeah, I mean, I think they're going to be working all through the weekend in Washington with various delegations trying to come together with to get some sort of agreement before next Wednesday. There have always been three buckets, as they say, of countries. There are those that are going to get deals, there are those that are going to get delays, and there are those who are going to get letters. And that's what the president was saying yesterday, is that the countries that we're not really negotiating with, that we perhaps don't even have a big enough trading relationship with, they're just going to get their number handed to them, as opposed to the negotiations that are going on, as we know, still with the European Union, with Indonesia is apparently close. India is also another country that we're hearing is close. So this is how it's going to play out over the next 5 days. Is you're going to either get your tariff handed to you, or you're going to try to negotiate a lower one.
So once you get the tariff handed to you, there's no negotiation.
Not in the short term. That's the tariff that's going to, as we understand from the administration, that is what the imports, that country's exports into the U.S., that's what the rate is going to be.
Brendan, what do we know about EU-China? It seems tensions are rising a little bit from the economic front.
Yeah, exactly. These tensions have been simmering for a while. We reported yesterday that they've cut this 2-day summit, this EU-China summit that's happening in China in a few weeks. They've cut that in half down to 1 day. So clearly they're going backwards in any efforts to try to come together as their bilateral relationships with the U.S. deteriorate as well.
Okay, Brendan, thanks so much. Brendan Murray there, our trade czar. Now, President Trump has scored a big win with his big, beautiful bill passing the House. The $3.4 trillion fiscal package passed Congress just hours before Trump's self-imposed deadline of July the 4th.
Very simply, the one big, beautiful bill will deliver the strongest border on earth, the strongest economy on earth, the strongest military on earth, and ensure the United States of America will remain the strongest country anywhere on this beautiful planet of ours.
So we have tariffs, we have trade, and then we have possible policy changes on the back of this sweeping bill. First of all, Nataliia, how does this play out in the markets? Because again, there's quite a lot, especially given we had some pretty good figures from the U.S. yesterday. I mean, if you're an economist, if you're a trader right now, do you just wait to see what happens with trade, or do you look at the sweeping bill and say, something will happen on taxes or inflation?
Good morning. I think the market is quite cautious with regards to what happens with tariffs, but overall we continue to be actually quite constructive on the market. I think it's fascinating to see how the S&P just snapped back to all-time highs again, and we're just 2 weeks ahead of the earnings season. And the market is quite cautious, meaning that the expectations are actually quite low. So there is a high chance that companies will actually show a bit better results than what the market expects. And remember, tech is a big part of that. And we continue to be quite positive on that sector.
Okay, so we'll talk a little bit more about tech. But in terms of policy changes, because of the sweeping new bill, Roz, are we expecting any big announcements or, again, industries that could really benefit or on the other side, really be hurt?
It'll be interesting to see how long it takes for this to filter through to consumers, to companies. and the economy. I mean, it's certainly a big bill. It's arguable whether it's beautiful, but it does a lot. And it seems to front run particularly the tax stuff. That's going to be the thing that really kicks in soonest, is making some of these cuts permanent for consumers, and also some of the business tax, which they may welcome, including things around R&D and depreciation around certain assets. So those elements may start to filter in immediately. We did have that jobs data yesterday, for example. I mean, companies have been a bit cautious around hiring, about their outlook, what to do, because they're trying to judge all these elements we've been talking about, tariffs, this bill. But what it might do is have a sentiment shift. Obviously, that they can say, well, hang on, these tax changes are now through, they're going to be solid, so this can change perhaps consumer behaviour a little bit. Maybe it changes company behaviour. On the downside, of course, we've got the acceleration of the removal of these green credits from the Biden administration. Those were actually quite popular with business and in certain states as well, which will be interesting into the mid-year election that's coming up before too long. They were quite popular, including the EV subsidies and so on. And so whether that has a negative effect in some certain businesses and some certain sectors as a result. But overall, they'll probably focus immediately on the tax stuff. What we're going to see is the cuts to things like Medicaid, to benefits, the things that may depress sentiment. Those will come later. They may filter through later and have an impact on the consumer outlook and on inflation, and also on the midterms again.
Nataliia, when are you expecting, and again, I mean, we had also a policy panel actually in Sintra with Jay Powell. And the big question is, when are we going to start seeing some of the impact of tariffs, trade, and these changing policies on inflation? He said, look, it could take a couple of months, but he's ready to readjust. I mean, are we going to see, a hit to employment, a hit to inflation and the economy?
I think it was fascinating to see yesterday's data. We actually saw the unemployment rate going down. And you've seen that the labour market so far is actually much more resilient than a lot of people have expected. And we haven't actually seen the impact on inflation yet either. So what we think will happen probably this year, we will have a bit of a hit to growth this year. But most likely next year is going to be another good year. And similar for the earnings as well. Yes, most likely the earnings may be impacted this year, but we're likely to go back to the normal range in 2026.
Does the dollar continue to weaken from here?
We think so. We think so that the euro-dollar goes to 120 by mid-2026. And again, one of the themes that we have been talking at JP Morgan is around the global investing. So not just sticking with the big overweights in the US, but also considering other markets like Europe, for example.
And Ross, going back to the bill, I mean, the final version was actually costlier than the House's earlier version. So how much blowback should the Republicans, be braced for in the midterms?
Well, that will be interesting. It's kind of how you sell it. Do you lean heavily into the tax stuff again, which can be quite popular for individual voters, and steer away from the fact that they are cutting Medicaid and other benefits for people? Again, it's which lane do you take? And if you're a dyed-in-the-wool Trump supporter, they already say, you can see it in polls, that they believe that these cuts to Medicaid are actually necessary, and they're willing to take some pain personally for what they see as the greater good. It's the voters who perhaps drifted away from the Democrats in the last presidential election, who just didn't want to vote Democrat and shifted over to Republican as a result of that, or somewhere in the middle, do they peel back in the midterms, and therefore do the Republicans take a hit? Because again, we can see from the passage of this bill through the House, the Senate, back to the House, there's not a lot of fat there for the Republicans, in terms of pushing legislation through. And this was very fraught, again, because it was a big, complex bill. But do you see the makeup change as a result of the midterms? And again, it's going to be in those states, selling it to those voters, leaning on the tax element.
Ross, I mean, we talk so much, of course, about the employment market. What do we know about immigration? Because that must skew everything, given the enormous amount of immigration crackdown that we've seen from IC.
Well, that's right. And that's been going on, since the onset of the latest administration, and accelerating very quickly. Like everything else, Donald Trump is moving very fast and very visibly on the immigration front. We can see, many, the footage of these ICE arrests, the tensions going on, and certainly tightening up on the border. And this bill has some elements of that, again, funding to continue that crackdown. The reality is that migration is an essential part of the US economy. The same for any economy on the planet. Skilled migration helps your economy. I mean, all the evidence shows that. And so if you take away some of that migration and some of that labour force, what are you left with in key sectors of the economy? It's harder to pass that in data. It's harder to see it immediately, but certainly it could be a sentiment issue in some areas in the midterms. But people will probably focus more, to be honest, on the tax element and the spending element.
And Nataliia, when you look at some of the key global themes, I mean, you still like actually tech that you mentioned, and I wonder whether that's an AI play, but utilities and also financials in the U.S. from like just a purely market perspective.
Yes, so in financials, we think that deregulation is actually here. And if you have less capital requirements, that's actually very good for banks. Banks can pay higher dividends, they can do buybacks, but also there is a change for M&As and the loan origination. So overall, we've seen some of that already in the last couple of days, and the market takes it very nicely. The market really likes it. And tech and utilities, it is an AI play. Yes, both of those sectors. We continue to like AI. Companies spent a lot of money on developing AI. We think that more and more companies will ultimately incorporate AI. Right now, it's not a big percentage of companies, but if you think about how AI can actually impact the business just becomes more efficient. And these big tech companies just continue to increase their capex. Right now, the big hyperscalers spend 25% of overall S&P capex on AI. So clearly, we think that there is more to go in this space.
Nataliia, when you also look at some of the finance, I mean, we're expecting, I remember like January 16th, 17th, a couple of days before inauguration, everyone was saying financials benefit from massive deregulation. Is that really coming?
Yes, we think so. And if you look into even this week, we had some of the major banks talking about higher dividends and incorporating more buybacks. So we think this is actually already happening in the space.
Now, we have a viewer question. I love viewer questions, especially on a Friday. Thank you so much, Mr. or Mrs. Viewer, for sending that in. Roz, what further legislation do you see coming before the midterms that may boost or hurt markets? I mean, is there anything that actually we should be watching out for?
Well, he kind of put all his ammunition into this bill. And this covers, again, it's, as I was saying, whether it's beautiful is one thing, but it's certainly big. And that was one of the reasons it was so fraught, because people kept tacking things on and changing it. So it's got taxes, it's got spending changes. Obviously, they've bought themselves some breathing room again on the debt ceiling. So that isn't something they're going to have to explain to voters in the coming months running into the midterms. So he may have spent a lot of his firepower on this bill. There are obviously other things that he's talked about doing. He wants to legislate in a bunch of different sectors, but he really put all his eggs in this basket to start with, and he probably wants to see how this impacts on everything, hiring, corporate decisions. I mean, again, he's not someone who just uses legislation to get his agenda done. He's pushed a lot on the tariff front, obviously, directly. He's using the power of his own personality to try and compel companies to come and invest in the US, announcing factories, shifting production either to the US or back to the US. A lot of it is about his personal behaviour and interactions with companies, with CEOs, with heads of state, frankly, as well, alongside using Parliament. A lot of the question in all of this is how much power has come into the White House to enact policy without Congress.
And Nataliia, I mean, given, again, it's a lot, with the personality to get things done. When you look at, markets are near an all-time high. I mean, what does this mean because of all the uncertainty? I mean, it's a little bit of a strange, so markets are at an all-time high. Volatility and uncertainty is probably also at an all-time high. So how do the two match up?
It's usually very concerning for people to look into the market and say, it's all-time highs, shall I invest or not? Yeah. But when we look in our analysis, it actually shows it doesn't really matter if you invest at all-time highs or not. In fact, new all-time highs usually lead to more all-time highs because there is a bit of momentum in the market, and we're in that camp. When you look into the fundamental analysis of the companies, we're actually seeing a very decent growth. Yes, maybe the earnings this year will be a bit impacted by tariffs. We're still yet to see that. But we think that next year, for example, in the US, we're going back to double digits. So overall, we're still quite comfortable, even though the market is at all-time highs right now.
Are they spending less because they worry about what they're spending into and because they're worried about policy from the White House?
You mean
like CapEx investments for a lot of these companies?
Well, in fact, I think that was a big worry in the first quarter, that big tech companies will not spend, the AI trade is done. We're actually seeing the opposite. We're seeing the re-acceleration of that CapEx spend. And we think that this is the reason why the tech earnings this quarter may actually surprise again, because the trade is still on. I mean, the AI trade.
Thank you both for joining us. Nataliia Lipikhina, their head of EMEA equity strategy at JP Morgan Private Bank, and Ross Matheson, our EMEA news director. Coming up, after a stellar first half of the year for emerging markets, we'll also ask if that rally is set to continue. That's next, and this is Bloomberg.
The price of the dollar has nothing to do with a strong dollar policy. Strong dollar policy means several things. One is what is the dollar strong against, or is another currency stronger, higher in price at the moment? That doesn't have anything to do with a strong dollar policy. The strong dollar policy is, are we doing the things over the long term to ensure that the U.S. dollar remains the reserve currency of the world? And we are.
Well, that was U.S. Treasury Secretary Scott Bessent speaking to Bloomberg yesterday about his view on a strong dollar policy. Now, emerging market assets have continued their rally into the second half of the year. EM bonds, stocks and currencies posted their best first half gains in years as President Trump's policies prompt a flight from U.S. assets. Now, we're joined by Omotunde Lawal, head of EMEA corporate credit and emerging market corporate debt at Barings. Tunde, thank you so much for joining us. There's a lot going on in emerging markets. So first of all, I mean, does it really all depend on the dollar, more or less? And then you go into structural reforms if each country has done them or not.
All right. Okay. So yes, as you said, EM has had a very strong first half, and it's actually quite refreshing to see that, because I feel like EM has been in the doldrums for quite a few years with all the geopolitical noise and all that, and so it's quite good. Yes, a weaker dollar is good for EM optically, but likewise, when we see the stronger dollar, we try to make the point that it's a mixed bag of impact for certain countries, whether it's a weak dollar or a strong dollar. If you think about EM as a basket, it's 65 plus countries, so there will be winners and losers within that. In this particular context, a weaker dollar has been positive because we're seeing more fund flows into EM, whether you attribute that to that de-dollarization trend or people just trying to put their marginal dollar to work elsewhere. For example, at the end of May, we had year-to-date outflows from EMD as an asset class was 11 billion of outflows. As at last Friday, it was only minus 6.5 billion. Right. So you see how much fund flows have really come in. And that's because you're going to get stronger commodity prices because there's slightly more demand coming through. There's more demand for EM assets, so prices are going up. You're seeing the total return numbers that we're printing for EM. So it is a mixed bag, but by and large, from a sort of optical, it is quite good, most especially for EM local assets. I think that's where the bulk of the inflows have gone in.
So that's how you want to, I mean, do you catch a falling knife? So is it when there's a bit of a sell-off that you want to get in, or is now a perfect time?
We advocate just getting in now, right? Because if you're thinking about the point that we made where for years and years, most of the 80-odd% of investments of every dollar has gone into US. And now it's just about rebalancing. It's about putting that extra more than 20 cents to work elsewhere. So, you're not necessarily catching a falling knife. Yes, you could have thought spreads were tight at 230. Now we're low 200s, and maybe we go inside 200. We've been inside 200 before, right? So it's not about catching a falling knife. It's about taking a longer term view and saying, actually, structurally, do I want to be allocated to other parts apart from the US? And with that comes the technicals, where you will see spreads growing tighter, even though they might be optically tight now.
I mean, you're right. I'm getting ahead of myself. But the problem, I guess, is the tariffs, right? That you don't really know where they end up. And I guess the first point of call is you have to see whether this is a starting point for negotiation or whether this is simply money that the U.S. administration wants because they need to pay for other things. Yeah. So that, again, two very different psychologies, and that would give us two different outcomes.
Absolutely, absolutely. So I'm in the camp that actually these tariffs are really about raising funds to fund the big, beautiful bill. So, there was a stat that came out a couple of days ago. It said, I think the U.S. got something like $28 billion in tariff revenue already just in the month of May. So it is working. If you think from their perspective, it is working. However, there is a cost to everybody else. And, we're seeing this tariffs. We're watching very closely their deadlines coming up 8th and 9th. We saw Vietnam a couple of days ago. Everyone's been talking about the impact for Vietnam. But for me, what I'm really reading through the tea leaves is that the US is really trying to tackle this content of local origin. It was a big bugbear for them in the USMCA, right, with Canada and Mexico, content of local origin, content of local origin. It seems they're repeating the same playbook here in Vietnam, where it's about 40% tariffs on things that are transshipped, which is trying to really crack down on content of local origin. The conversations they're having with India, they started asking for 60% content of local origin. India is trying to bring it down to 35%. And the problem there is a lot of emerging markets do not have the infrastructure for manufacturing. A lot of them rely on the intermediate goods that they bring in from China, and then they further process it. And so it's going to take years, it's going to take capex for a lot of these countries to actually bring their manufacturing capabilities up. I mean, look at Europe. Europe is trying to spend huge amounts to bring up its defense manufacturing capabilities.
So Germany's going for it.
Exactly. And so you look at emerging markets, just there's so much that needs to be done to put in place, and it's about navigating that intermediary period.
So first of all, for these trade, and tariffs, where are you expecting it to end up in China and Mexico? I mean, these are probably the big ones.
The big ones,
right?
Yeah.
They give us also an idea of how kind or mean he'll be with neighbors, and China.
Yeah. So the China one, it's very complex, and at the moment, we've got a little bit more leeway till mid-August to really see how it shapes out. But you've heard sort of murmurings from the Chinese camp suggesting that whatever deals the U.S. is striking with other countries, so long as it's not to the detriment of Chinese interests. And so you can see the potential for additional tension with the U.S. coming from that. I think the Vietnamese one is one, potentially Cambodia, potentially some of the other Southeast Asian nations. So for me, that puts me in the camp that I think if we are going to have a few more bumps along the road before US and China do reach a real trade agreement. Yes, we have the one around the rare minerals in exchange for semiconductor chips and some other stuff, jet engines, I think it is. But I think in the grand scheme of things, they are going to have to sit down in a room and figure out, okay, how much local content really are we talking here, and how much are you going to sort of ask of other countries? Because US has to also appreciate that they can ask for only sort of 60%, 70% local content, but if these countries can't deliver it.
I mean, again, I guess with China, it's more like you have to make a call on whether this is, trying to have overall supremacy on tech and other things. And so whether this is a way of crushing China or it's really a way of negotiation.
I think I'm in the camp that it's about negotiation, because I think the genie's out of the bottle. I strongly wonder if US can really tame China. I think, you're all, it's too big in a sense to take on. It's mutual self-destruction in a way, and so it's really about negotiation is my sense of it.
When you look at, de-dollarization, I mean, one of the questions is, look, if you're a central bank, an emerging market, and you don't feel comfortable holding dollar reserves, I mean, can you just buy gold? Is it the only option, or is there another option, for example, with renminbi or something else?
We're seeing and hearing increasing chatter of people looking to sort of diversify trade flows into other currencies. Renminbi is certainly one. The euro has been a big beneficiary of that as well. But let's be honest with ourselves. The US is still the reserve currency. It's still the one that people will go to. It's still the most liquid market. It's the most open market. And so when we think about de-dollarization, there's only so much gold you can buy as well, because you've got issues of physical storage as well of gold, right? So yes, we've seen central banks diversifying reserves into gold, some people diversifying into other things, but actually there's only so much gold you can buy and store, and so ultimately you will have to see people putting, the reserve currency status is probably still assured for a while, which is probably what is behind Besant's comments from earlier as well, because we have no viable option yet. But is it chipping away at that? Potentially.
I think we'll see in the next couple of years, because it's a long-term process. It's not going to happen overnight. Omotunde, Lawal, thank you so much for joining us. Head of EMEA Corporate Credit and Emerging Markets Corporate Debt at Barings. Coming up, President Trump says Putin will not back down as Russia unleashes another barrage of strikes on Ukraine. We'll talk with Elisabeth Braw from the Atlantic Council next. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump says he'll start sending out unilateral tariff notifications today, with some levies as high as 70%. They'll come into effect on August 1st, while European stocks slip. China imposes anti-dumping duties on European brandy as tensions escalate between Beijing and Brussels. Plus, Trump's signature $3.4 trillion tax bill passes Congress. He's set to sign it this afternoon. Now, OPEC Plus is considering another supersized output hike despite faltering demand for oil and plentiful supply. Now, the price of crude has whipsawed since the group's last meeting earlier this month, spiking at over $80 a barrel after the U.S. bombed Iran's nuclear facilities, but quickly pulling back after last week's ceasefire. OPEC Plus meets on Sunday. Well, joining us now is Will Kennedy, our senior executive editor for energy and commodities. Will, thank you for joining us. So what's OPEC hoping to achieve?
I think the strategy has been quite clear for a while, is that they want to put oil back into the market fairly quickly. The group, where policy is led by Saudi Arabia, has decided in the last few months to switch strategy from constraining production to keep prices high to steadily supplying the market, accepting slightly lower oil prices in return for increased market share. And I think they'll continue with that.
So Washington stepping up pressure on Iran?
Yes, I think it's a lot of talk, and I would question how much action it is. It's a really interesting question. Obviously, we had that slightly bizarre social media post from the president after the ceasefire that said, now China can keep buying Iranian oil, which isn't the stated aim of US policy and this idea of maxing. But in a way, it's consistent. It's consistent with what the Biden administration did, which was to turn a blind eye to Iranian exports. Yeah. And both administrations want oil prices to stay low, and it's part of that strategy. So in some senses, it's consistent, and it's also against the background of trying to reach a trade accommodation with China.
But, well, I mean, for me, again, you were sat at the same chair, the same desk, like only 2 weeks ago, and it felt like something big would happen. We're talking about the Strait of Hormuz being hit. Is it really now just going to go away and back to normal?
Honestly, it looks like that. If you look at the chart of the price, it's like, here's a 12-day conflict, and the conflict's over, so we go back to the status quo antebellum. So the market has become quite clearly much more comfortable with political risk in the Middle East. The salient fact is that none of these conflicts have disrupted oil flows so far. And going back to the earlier question, Iranian oil production and Iranian oil exports are at multi-year highs. And that oil is coming out of the Gulf despite the geopolitical tension and despite US sanctions.
Will, thank you so much. Will Kennedy there, our head of global commodities. Now, Israel intensifying military operations in one of the last Hamas strongholds in Gaza as the sides prepare for ceasefire negotiations proposed by President Trump. The Israeli army has ordered tens of thousands of people to leave the outskirts of Gaza City and stepped up airstrikes. The Hamas-run health ministry says more than 300 Palestinians have been killed since Monday. In the meantime, Russia launched a massive drone attack on Ukraine's capital, Kyiv, hours after a call between President Trump and Russian President Vladimir Putin. Now, Trump expressed frustration at failing to make progress towards ending Moscow's war on Ukraine.
We had a call. It was a pretty long call. We talked about a lot of things, including Iran. And we also talked about, as you know, the war with Ukraine. And I'm not happy about that. No, I didn't make any progress with him today at all.
Well, joining us now, Elisabeth Braw, a senior fellow at the Atlantic Council. Elisabeth, thank you so much for joining us. I have a lot of questions on Russia, on Israel, and also on Iran. But first of all, update us on the situation between Israel and Gaza. I mean, there's an international outcry for still Israel to stop, but I don't know who could have control or try to temper the Prime Minister Netanyahu right now.
Well, that is the big question. We have seen condemnation after condemnation from European leaders about the situation in Gaza, about the fact that Palestinians get shot while trying to get get food from the humanitarian foundation that has now replaced UN agencies and other charities in the food distribution. And so there's been a wave of condemnations, but nothing has changed. And that leaves us to assume that President Trump is the only person who really can have an influence. And it's not clear how much attention he's paying to that situation and what assessment he will make at any given moment.
Yeah, I was going to ask you, like, how much do we actually know about where he stands on this? Because it's also, Benjamin Netanyahu that kind of pulled him, I don't know whether knowingly or not, into this Iran war.
That is the great enigma of this war, both the Gaza war and the Iran war. Where does President Trump stand? When he was elected, and before he was elected, I think we all remember Israel felt he was likely to be an extremely staunch ally. But since then, he has run hot and cold on Netanyahu. Sometimes he has almost openly turned him down. Sometimes he has openly endorsed him, and obviously the US stepped into the conflict with Iran on the side of Israel by bombing Israel.
What's happening with Iran? So there was talk about, there was 3-4 days where people were really on high alert. There was a lot of anxiousness about whether this means a much broader conflict in the region. And there was also talk about regime change in Iran. It feels like all of that has gone away.
All of that has gone away because apparently the US has no interest in continuing this armed conflict. The assumption was when the US bombed Iran that this was the beginning of a longer conflict. then it was announced that this was it. And that's why Trump was so keen to stress the point that Iran's nuclear facilities had been obliterated, as he said, and then it emerged that maybe they hadn't been fully obliterated, which then put the Trump administration on the back foot, because if you can say it has been obliterated, then you can say, well, we won this war and the objective has been achieved. But as you say, Francine, in the background are these rumors circulating that maybe it's not just about the nuclear program, maybe it's about regime change, which is a much more ambitious objective.
I mean, how do you see it playing out? Does this quietly go away? Or do you see Israel kind of, doing more? We don't really know the nuclear capabilities and how quickly they can rebuild them.
We don't. And what we do know is what the International Atomic Energy Agency tell us. And the IAEA has said that Iran can rebuild within months. And the question that then it poses for the US is, what are you going to do about it now that you've said that you've obliterated those programs, and then it emerges they may re-emerge within months. But I think this has less to do, what Trump decides to do has less to do with Iran or Israel and more to do with the sort of signals he gets from the MAGA base.
When you look, Elisabeth, at what's happening between Russia and Ukraine, again, there's some of the offenses, it seems to really have hotted up.
Yes, and frankly, Ukraine is in a very difficult position, and what has happened in the past few weeks is a tragedy for Ukraine, because the focus internationally has shifted away from Ukraine because of the conflict with Iran, because of the so-called Big Beautiful Bill. All of that has shifted attention away from Ukraine, and I think your readers may have heard that the US will reduce its support in weapons for Ukraine, but ordinarily that would be big news. It hasn't been such big news because the focus is elsewhere, but nevertheless it is terrible news for Ukraine.
So, I mean, what exactly happened? So they haven't lost, or is it actually losing territory, or is it drone attacks that are hitting cities?
It's drone attacks primarily that are, of course, designed to shatter the morale of the Ukrainian population, which has been so resilient despite now more than 3 years of war. But there are also gradual advances by the Russians and a little bit by Ukraine. But Russia has more resources, and then they can then claim that it's going in that direction, even though every square kilometer that is won has been won at great expense for Russia. But nevertheless, they are persisting because they think that things are going in that direction.
You're an important student of everything that's going on with security. Like, how much of your time are you spending at other possible flare-ups that we don't really talk about? It could be China, it could be elsewhere. The world seems in turmoil. It's very uncertain, and so I don't know whether you also feel this way, that actually something could happen in places where we're not focused on.
It could, and I think this is what the private sector is discovering or beginning to think about as well. Where could conflicts emerge, or where could we be targeted in areas that we haven't even thought about? So, for example, when it comes to the Houthis in the Red Sea, that was completely unexpected, and their attacks on global shipping. Could something like that emerge in another shipping choke point? And if so, what should shipping companies do and their insurers? And then, of course, we have the big fear of more attacks on undersea infrastructure. We have seen it happen in the Baltic Sea. We have seen it happen off the coast of Taiwan. Where else could it happen? And that could have, if there are more and more systematic incidents involving damage to undersea infrastructure, that would be absolutely disastrous for the globalized economy.
Thank you so much, Elisabeth, for joining us. Elisabeth Braw, Senior Fellow at the Atlantic Council, for a terrific roundup of all the security concerns that we have around the world. Now, we're also looking at trade. We're also looking at brandy companies. Rémy Cointreau, of course, this is the drinks maker that is listed in France, saying that there are impacts that are expected, but they're far less restrictive than those initially anticipated. They think that this represents a significantly more favorable outcome than expected, but they are awaiting more details, further details, to assess the impacts. You can see in today's trading session, Rémy Cointreau not doing much, down 1%. Now, coming up, a tariff shock looms over the global economy next week. The governor of the Banque de France joins us live from Aix-en-Provence. That economic forum is next, and this is Bloomberg. It's day two of the Economic Forum in Aix-en-Provence, with trade tensions between the EU, the US, and China looming large over the global economy. Well, Bloomberg's Caroline Conant is on location with a very special guest. Caroline.
Francine, yes, a very special guest with this music of the south of France, the cicadas you can hear behind me, and we'll hear what is the music of the ECB from the Banque de France governor, Francois Villeroy de Galhau. Very nice to be with you this morning.
Good morning.
We were telling me just a second ago, your biggest concern at the moment seems to be the appreciation of the euro against the dollar. We were in Sintra earlier this week, where the Vice President, Mr. De Guindos, was talking about 120 as the limit. What is your take on this?
So I won't comment on my colleague's comment. It's a general rule. But we look closely at the volatility of the exchange rate. It has been significant since the start of the year, with a 13% appreciation of the euro against the dollar. By the way, it's not a specific appreciation of the euro, it's more a general decline of the dollar against major currencies. So let me be precise on that. We don't have any specific target for the exchange rate, clearly. But this does not mean it's a benign neglect for us, because an appreciation of the euro has a clear disinflationary effect, which we take into account in our monetary assessment. To give you a simple figure, according to our estimates, if we have a 10% appreciation of the euro, a lasting one, it means 0.2% inflation less yearly, year after year, in each of the 3 next years. So it's a significant effect. If lasting, it would increase, it could increase, as several of my colleagues said, and myself, it could increase the risk of undershooting our target. that I don't conclude from that any signal decision for our July or September meeting, but this is a risk we must take into account.
So do you reckon that the risks of undershooting the ECB inflation target are currently increasing?
Due to this factor of the exchange rate, yes, for the reason I gave of a significant disinflationary effect. Let me add that if we look at the other hot question, which is a question of tariffs and a possible trade deal, I wish we will have one, we already know that it won't have any significant inflationary effect in the euro area, differently from the US, probably. So we don't see risk coming from inflationary risk coming from this front. But these are, if I may stress it, Caroline, these are all other factors being equal, which is a strong hypothesis, because we live in a world of huge uncertainty, even unpredictability. This is why we must remain completely optional, data-driven, meeting by meeting. We are not on a pre-committed path for interest rates.
You said last month that if the ECB were to act over the next 6 months, a rate cut would be the likely direction. At the moment, the markets are pricing a pause for the July meeting, and it's kind of 50-50 for September. Are you comfortable with that?
Again, I won't comment on July or September. We must take a somewhat longer-term view. This is, by the way, the purpose of our strategy review, which we adopted in Sintra and which is a very important step. We are at present in a good position. As Christine Lagarde stressed, we are 2% inflation and 2% interest rates. But a neutral rate, and 2% is probably about a neutral rate, but a neutral rate and terminal rate can be different animals. We will see where we go. But this is not a question limited to July or September. Again, in this uncertain world, we must be rather clear about our reaction function and be ready to be pragmatic according to data and agile, move if necessary.
So are you comfortable with the way the rate cuts are transmitting to the real economy?
Yes.
And what, in your opinion, could derail this?
Sorry?
And what could derail this transmission?
No, you are right. This is a very... I spoke of our reaction function. This is one very important of it. The two other ones being obviously underlying inflation, which is diminishing, and inflation outlook, our forecast. And we spoke about the various risks. But about transmission, it went rather well. And if you compare this cycle with the previous tightening cycles, I would say the transmission lag was 12 to 18 months. If we look at the funding of real economy, as you said, be it corporate or household, this funding is going on. We looked whether it was different in countries with floating rate or in countries with fixed rates, like France. It works well.
You were talking about the tariffs not having a significant impact. We obviously have this July 9 deadline. We may have the...
On inflation.
On inflation. In that case, if you have enough space, do you think the ECB should use this space to support economic growth?
No, again, I won't say anything about July or September. I try to give the rationale of our reaction function. Our first compass is inflation. And again, we are 2%. This is a good position. And this will be the first determinant of our policy decisions. If we are on our target and inflation, obviously we should look at the growth path and we can support, which we did. If I may stress it, we are in the euro area 2% interest rate. This is much less than, say, the UK or the US, which are at more than 4%. So when people say that the ECB does not support growth, they should look at figures.
May I have one question? Because we're here in France, you can hear the music of the south of France right here in Aix-en-Provence. In France, the inflation is way below the 2% target. And in fact, economic growth is also well behind the rest of the Eurozone. Do you think France risks becoming the next sick man of Europe?
No, I don't think so. Inflation below target, this is rather good news for real income and for competitiveness in this country. You are right, growth is too slow. By the way, growth in France in 23 and 24 was above the euro average, so there is some catching up. But we must look at structural reforms. We must diminish the uncertainty, including the fiscal uncertainty, which is for real in this country. So this is up to other policies. And part of this problem, of growth problem, is not French specific. It's really a European problem. We have a unique opportunity with this unfortunate US shift to accelerate Europe's reform. This is about the Letta and Draghi report. This is about the competitiveness compass of the Commission. Let me give one figure, if I may. We are at present more or less at 1% potential growth in Europe, and in France, by the way, it's growth. We should go to 1.5%, and we can do it. We have the means, integrate more the single market and savings and investment union.
Governor, I'm sorry, we're running out of time. We have to leave it there. Let's see if the Eurozone can seize this opportunity. Mr. Villeroy Galhau, Governor of the Banque de France, and of course, ECB Governing Council member here from the Aix-en-Provence Economic Conference. Francine?
Thank you so much, our Caroline Conan there. With, as she said, the music of the south of France. It's not a bad way of spending a Friday afternoon. Now, coming up shortly, Caroline will be joined by Marc Ferracci, the French Industry and Energy Minister, to talk tariffs, the French economy, and energy security. Now, in 2015, Greece was at the peak of its debt crisis, facing a potential default and ever an exit from the euro. But over the past decade, Greece has made a remarkable economic recovery, transforming from an economic outcast to a poster child for financial prudence in Europe. So let's bring in our Athens Deputy Bureau Chief, Paul Tugwell. Paul, thank you for joining us. So remind us, what was the situation like in Greece 10 years ago?
I think it's worthwhile reminding ourselves that why we're talking about this now is that exactly this week, 10 years ago, the then Syriza, left-wing Syriza party of former Prime Minister Alexis Tsipras had organized a referendum for people to accept or not the terms of a new bailout package. The government advised people to vote against. That's what happened. The result was against the austerity. But of course, we know the government was forced to capitulate and introduce more austerity measures. And in the week preceding that vote, we had the introduction of capital controls in Greece, obviously to prevent an exodus of capital. There were lots of queues, long queues at ATMs, people only allowed to withdraw 60 euros a day. And all of that was in the backdrop of a country that effectively had been excluded from financial markets for the best part of 5 years, where economic activity had virtually stopped, very little, where unemployment had skyrocketed, where the country had missed the deadline for a payment to the IMF, where there were demonstrations on a daily basis, violent demonstrations, and where we were in a situation where we didn't know whether Greece would either be asked or forced, on a temporary basis at least, to leave the euro area.
So what's the picture like today?
Well, in the past 2 years, Greece, or 2 years ago exactly actually, Greece regained its first investment grade rating from financial rating agencies. Economic growth, as you mentioned in the introduction, has rebounded, is now above the Eurozone average. And the country is only one of a handful in the European Union that is achieving budget surpluses. And of course, during the crisis, there was a big exodus of Greeks looking for opportunities abroad who weren't able to find work in Greece, especially among the young, the under 30s. And many of those have become returning home, as it were, because they recognize that the opportunities here are obviously much more than they were in 2015.
Paul, thanks so much. Paul Tugwell there, of course, from our Athens bureau. Now, don't miss the new edition of Bloomberg Weekend Newsletter, where you can get deeper analysis like the one we wrote on Greece, feature pieces and profiles that provide unique insight into really the latest news from around the world. It's a really great read, so I urge everyone to go and check it out. Up next to Bloomberg Markets, and this is Bloomberg.